Ali talked a lot about our business model, our investment strategy, how we are in the process of transforming our portfolio over the last couple years and in the future through development and acquisitions. And I'd like to spend just a few moments on our financial and capital strategy and how we think about capital allocation and how our balance sheet management supports our investment strategy. We are a perpetual life company. That's how we think about the business, which means we have to be able to operate through all phases of the real estate cycle, and especially with exposure to development, where we manage that risk very carefully. We feel we need to have a balance sheet that can support these activities. So we take a careful look at how we think about leverage. We like to maintain a conservative capital structure, approximately 40 to 50% leverage at any one time. We also want to maintain significant financial flexibility. So that means accessing all forms of debt capital, both secured and unsecured. Unsecured over time, we think, gives you a lower cost of debt capital, and it also gives you additional flexibility. If the capital markets aren't open, you can sell assets more easily to recycle that capital into new investments. Another very important aspect of our capital strategy is to have staggered debt maturities. We'll show you a chart in a second, but as we enter a period of heavy growth on the development side, we don't want to expose ourselves to the risks of the capital market. We like to spread out our debt so that no one year will put pressure on us from raising capital, or we might be subject to unfavorable market conditions. And certainly we always want to maintain financial strength so that as opportunities present themselves, we can take advantage of them. And you know, everyone here knows that you can't call a market top or a market bottom, so you have to maintain that capital cushion to take advantage of attractive opportunities. I think the last thing that I'd like to highlight, which Oliver touched upon in his speech, is what we are doing to the portfolio. One of the things I've learned a lot in the past couple of days is about the diamond industry here and its significance in Israel. And what we like to say about our portfolio is we are polishing the diamond. We, as Oliver mentioned, close to 100% of our assets as we complete our development pipeline will be urban, near Metro, which in the Washington, D.C. area, the subway system is key to the employment base and the access to jobs. And our portfolio really is a very unique portfolio. And we think that's going to help us in a number of ways. First, our first option, obviously, is to look at a recapitalization event through an IPO. We don't have a specific time frame for that at this point. As we move through our development pipeline, we'll start taking a closer look at that in 2017, 18, and 19. And we think, as Nathan mentioned, our portfolio would be very attractive to the public markets. But if the public markets are closed, our portfolio would represent a very unique portfolio of irreplaceable assets that either a private investor would want to invest in through a recapitalization, or we could do a strategic sale or merger with another large public company. And we think that that's going to give us significant flexibility. One thing that you may or may not be aware about the DC market in particular is the height limitations on buildings. You really can't develop more than 12 or 13 stories, so that does limit supply. It limits the size of properties in the market, and that helps both in terms of operating fundamentals. But it also creates a unique environment where any one building is not necessarily a large transaction for an investor. So Nathan talked about Boston being the educational capital of the world, or at least the U.S. for sure. New York, the financial capital. San Francisco, the technology capital. D.C. is the political capital. So investors both regionally and nationally as well as internationally know that D.C. is not going anywhere. And so between the size of the assets and the competitions for assets, it is very hard to acquire. And we've assembled a portfolio that it would take most companies decades to replicate. And we think that's going to help us from a franchise value over the next couple years as we continue to polish the diamond, as we like to say. Here's our debt structure. As you can see, again, we're entering a period of significant development activity, and we really don't have any pressure from debt maturities. The tower that you see in 2018 is our revolver, which comes due. We have very favorable relationships with our banks. Our banking relationships are the largest and best banks in the U.S., and typically a revolver would be a 3 to 5 year facility, so naturally you would see it in the front end of your debt maturity cycle. But again, over the next couple years, nobody knows what the macro environment will look like, and we really feel that we've structured our balance sheet to withstand any unforeseen cyclicality. Oliver talked about our development activity along with our acquisition activity, and you can see we expect that our NAV is going to grow fairly significantly over the next couple years as our development projects come online and start cash flowing. A lot of our, if you take a look at this chart, our NAV per share roughly, I would say the value creation is 2/3, 1/3, 2/3 from our development assets and 1/3 from our operating properties that we have today. This is just a snapshot of our occupancy and portfolio trends. Again, coming out of the recession, and DC was not immune either from it. We saw occupancies dip, but at the same time, there wasn't a significant amount of construction, so supply tightened. The government did take a pause in spending, and that had a ripple effect even in the private sector in the Washington, D.C. area. It is starting to ramp up again, and we've seen it respond in terms of our occupancy levels and our leasing, and we actually expect to be slightly higher than where it's showing if our leasing remains on track by the end of the year. This slide is just a snapshot in terms of how we think about cost of capital and the margins. You saw the 5.9% NOI yield on our current portfolio. We're financing it at 3.5%. That gives us a very strong margin in terms of yield to work with. And again, my particular responsibility is to continue to drive down that cost of capital. Oliver also mentioned if we're developing, call it high 6s, low 7s, this is our operating portfolio, 5.9, so you've seen growth in the yield of this. This is the current yield from an NOI perspective. But clearly we could sell both our current portfolio and our new developments at a valuation cap rate much lower than that 5.9%, which creates a lot of embedded value on the balance sheet. So just to summarize, again, I think you've heard the Carr story today, but we really do have a unique opportunity as a DC-focused company on office in one of the best office markets, not just in the U.S., but we think globally. It's not going anywhere. It's a very diversified economic base, and we've selected locations for our assets that, again, are irreplaceable and should stand the test of time, as well as be rewarded for their locations in terms of rent growth. We focus on customer service. We focus, as Nathan said, you can have two buildings in the same location, but how the management runs it is extremely important, and we think we have a real unique competitive advantage in that front. And our development is a competitive advantage. A lot of investors, whether locally or nationally, as we talked about, can come in and acquire assets. But development really requires a unique specific local knowledge. It's much harder to develop, obviously, through the entitlements, through assembling property, and between Oliver and Dan on the leasing side, and certainly Austin, who's done a fabulous job in building our development pipeline, we think we have a real differentiator in terms of our ability to create value over the next couple years. With that, I'll turn it back to Nathan.